Hello everyone and welcome back to another video. Today we discuss everything to do with the stock, crypto and commodities markets and the key levels that you need to be looking at. We've got a breakout in oil that's going parabolic, but is this a breakdown in the economic indicators and the health of markets across the world? Stay tuned as we take a look at all of that and more. This one is sure to be a good video. See you soon. All right, well, welcome back to our market recap here for the 1st of March 2022 in terms of the close. If you like anything to do with stocks, cryptos or commodities, please remember to subscribe and smash that like button if you get value out of today's video. So we'll begin here in the heat map of the S&P 500 large companies. It's a great place to start. And you'll notice that it was a sell-off in a few sectors. Semiconductors really took a beating, financials, and then of course energy and consumer staples or defensives were up. When we think about the sectors and the session and what happened, the market actually started here a little bit bullish. It was kind of flat for the day. It showed some signs of weakness and then sold off through the session. We were kind of negatively biased in the previous point because we were at a key resistance. But, you know, things change. Every day is a new day here in this highly volatile market. What did we see happening, though, in sector analysis? And this is where people really make mistakes in the market. They don't tend to follow the sectors. It's a big deal, and that's why we always talk about it. Well, we saw gold moving up, we saw minerals moving up, and we saw one of our new favorite sectors that we've been on this week, which has been solar and tan. So tan's done incredibly well here in comparison, and we'll take a look at that later on a chart. I'll show you how I sometimes spot markets before they end up happening. But let's talk about also what's happening here with jets. Jets and financials and semis down hard. US 10-year yield and 2-year yield dropped pretty heavily. We saw jets getting beaten around because, of course, of the invasion. And remember, jets is one of those lead indicators into the recovery play. If you see a good technical on jets, as in the sector, it can really start to present opportunities throughout all of tourism plays. And we'll show you again one of the lead indicators that we use for that. So we've talked about this chart. It's souring on tech. Basically, it's an idea that there's a huge amount of shorts currently in the market faced on QQQ. Now, there are quite a lot of shorters out there. We've seen a lot of people shorting the Russell recently, a lot of high names, and a lot of big players really attacking this market. And time will tell whether they're fully correct and how much lower it will go. But it's interesting anyway to see them adding to their shorts. That's something that's a little bit, I guess, disconcerting when the big guys continue to go at it. It's not retail. This is big traders going in. The average excluding recession pullbacks. So if we're not facing a recession, usually the S&P 500 is going around 15% down. Now, we know that this is historical S&P 500 correction since 1965. So basically that's what it is. We saw the NASDAQ go down 20%, which is technically any lower, and you're starting to go with, of course, a bear market. And the S&P 500 20% down would be around 3,800, which has been one of our case scenarios should this continue to worsen. A lot of that will come back to the Fed. Now, speaking of the Fed, this is a great chart shared in the public Discord community. If you haven't got in there, I really encourage you, click on the links down below and make sure you jump in there and get involved in the community. It's a great one, and we're getting on like 7,000 members plus. So it's fantastic to have so many people in there. But let's talk about what's going on with rate hikes. You notice something here on this back end. Everybody was talking about 50 basis points. In fact, I thought 50 basis points was pretty much going to be assured. They were going to smash the market with a big 50 basis points. That's now moved down to 25 basis points as the expectation on the shorter March pick. So this is crazy when you think about it. At only a little while ago, before this whole invasion thing happened, the Fed was tipped to do a 50 basis points upgrade. And now they're only tipped to do a 25, and some economists are saying 0 now. So it's just amazing how fast things move in this market, and therefore your perception of the market must change as well sometimes. S&P 500 midterm election years, we have talked about this year being a trader's year and obviously a investor's year when they know what they're picking up. But look at this chart that's taken. Not only is there weakness into the start of the year, but actually historically March has turned around. This is again since 1946 in the midterm years. And then it's weakened hard, and we've had, really bad kind of ends to the year as well, followed by, a super rally that ends up jumping through into Jan and Feb. Could this year be the same? Continue. It's so far done very similar things. Let's find out whether it continues to do it. We had that tendency to think that maybe somewhere around March, especially when, of course, the Fed end up coming out with their result, there could be that sell the rumor, and of course buy the news. So buy the actual fact when things are changed. There are some things that we also look at always from more of a macro environment. Are we in a recession? Well, usually you see a big inversion yield that points, that's the canary in the coal mine, should you say. It usually points towards a market that is going to go into a very bad period of time. It's been highly accurate, and this is where the 2-year and the 10-year basically invert with each other. That hasn't happened yet, but it's continuing to rise here in a pace that is a little bit scary, and we'll continue to pay attention to that. We've also talked about DCA investing. So some people like doing dollar cost averaging. It's a fair technique. If you have high conviction, if you buy little bits and little parcels when you get them and you hold that cash for it, it's a good way to get ahead of the market. And of course, this is the S&P 500 above the 50-day moving average. Only 24.66% of stocks were actually above the 50-day moving average as of the close in the last session. So it's getting down there. And of course, if it ever gets under 10, it's something you should be paying attention to. The VIX spiked 33.32, not quite up to the 37, but take a look at this. It's the first daily close we've got above 32. You know what's weird about the VIX is it's spiking up, yet the market barely turned down. It's not like the market's gone to a new low. Very strange. And the VIX is certainly looking like it's kind of swelling up at the moment, which is a weird thing. Usually the VIX likes to go woohoo and then go straight back down. At this point, the fear is continuing to rise in the markets. In terms of put call ratios and what's going on there, we're continuing to see a lot of people place call positions. The puts are actually dropping in the S&P 500 at this stage in terms of the short date. And that is again a cause for concern. If everyone's gone bullish on calls, it can be a bit of a problem. We're just looking at the stats here. This is just what the charts are currently telling us. We'll move over to gold. So gold did bounce back. It actually broke through the 1922, which was a key level we had, and it just kind of went up. And that's nice. I mean, obviously, if it pulls back to this 1922, there could be a really great long here back into the 1960. And we've spoken about that 1960 level. If it breaches through there, we're kind of going towards the 2000 plus zone on gold. And if rates continue to drop, it actually may be more positive than you think for the gold trade. We'll continue to stay on top of this, but for now, that's the key levels that we'll be looking at. So the elephant in the room, and yes, I have been talking about this for a while, and yes, I did say at 92, for me, it wasn't necessarily the greatest trade. And I want to quickly clarify that. The reason I don't like the trade after 92 was firstly, it hit my profit. If you look at the weekly, it hit everything. I've been way more bullish on oil than pretty much anybody else out there, I would say. And it hit that bottom end. And sometimes you've got to say, that's what I wanted. Now, obviously, scaling out of a position is very good. And if you held energy stocks, that's the type of thing that I have done. You scale out of those stocks. But where we're at right now is an amazing point. I mean, 110 oil is in the sights. And we haven't seen this point since 2012, 2013. This is the high of all of those periods after the global financial crisis. This is crazy for oil. Now, we know oil's got once to 147. This would be very bad for the economy. It is not what we really want to see with this hyper extension. So here's the thing with this market, and we suspected it might do this. It's gone into parabolic mode. And when a market goes into parabolic mode, when eventually it does fall over, you've got to expect incredibly wild moves. So just be warned, if you're in this right now, cool, that's great. But have your risk management strategies ready. And 110, now that's a resistance that's multiple years in the making. Let's talk about Tesla. We'll go into some stocks, then indices, then crypto. And I'll say Tesla's holding really well. I thought it might fall through the bottom in the previous session, and we talked about that yesterday. It hasn't. If it does fall through the bottom, though, you've got to think next stop for it is 820, 800. But really, who is a beneficiary? I mean, if you're thinking like visionary in some ways, who could be a beneficiary of high oil? I mean, it could be Tesla, yeah? So really, if oil continues to stay dominant here at above whatever, 110 a barrel or 100 a barrel, then it may end up causing a lot of purchases here, which will have a positive impact in Tesla's growth curve. So I think this is one where day trading, it's great, but also for people that really like Tesla, maybe this is galvanizing your strength and your feeling towards the stock. I mean, it's another thing that you can latch onto across everything else that you've discussed. And I'd probably look at whether Tesla is really exposed, and I don't know this, whether it's really exposed to oil costs and whether that in the manufacturing process, etc., is really going to hit them, because obviously rising costs is a problem as well. Certainly something I'd be looking at. Nvidia did have a short. This is our other favorite kind of at the moment, a heavily retail traded stock. Semiconductors really get hit around as well during these kind of periods of uncertainty. It is a pretty highly priced stock, a great stock, but a highly priced stock. And it broke underneath our little level for day trading. It came back down. And if it gets under 230, I think the next stop for Nvidia could be around that 210 again. So I think, again, there are some shorting levels here. If you're feeling super bullish on it, if it breaches through this peak, then you move back to the trend line. I think that's a fairly solid play as well. Just like with Tesla, they're both trapped and you're just really waiting for that play out. If you prefer to just short one market or long one market, if I was to pick one right now, it'd be the S&P 500 or the NASDAQ. They are the most solid positions. Whenever the VIX goes crazy, I like to just solidify into your best picks, as in what makes the most sense, what's going to give the least false signals. And the key is always going to be in the market. So it's better to really go and attack those markets. And if you see weakness in the S&P 500, maybe then you trade the NASDAQ short, or you trade, of course, the Russell short, because the Russell's going to move at a factor faster than the S&P, being the larger companies. Just that outside of the box thinking is something you want to do. Usually the moves are exacerbated each way, so it's more of that volatile kind of market condition. Now, we talked about ARK, and we knew that this was going to be a problem for it. Downward trend line, incredible downward trend line. Let's just look at this. Oh, wow, that's a downward trend line. And it hit the 20 moving average and it's rejected it again. Something that's super important. And at this stage, if you're feeling positive about ARK, you're really looking for it to come back down to 65 and then, of course, turn at that point. That would be fantastic level for us to be looking at. So IWM, this is the Russell 2000. Again, we don't know that the economy is looking better until it really breaches through this 210. It's one of our early factors. Bonds would currently suggest that the market is still looking a little bit weak. It hasn't, the bond guys haven't said, hey, it's a turnaround yet. So that's also a downward sign. But if IWM breaks through here, it's going to be hard pressed to go against that in some ways. We've also got TAN here, which is the solar market. And this is something that I think a lot of people don't do. They don't look at their ratios and competitive, like basically how is this sector performing versus, let's say, the market. Here we've got TAN versus SPX, so S&P 500. What you'll notice is it's been a horrible downtrend. It's actually been very accurate at picking resistances. And then all of a sudden, what happened? We saw this bounce and it breached through. And then, of course, we saw an explosion in price in comparative to the S&P 500. This index is now outperforming the S&P 500 by a large factor, and it's doing quite well. So that's basically long TAN, short the S&P 500 if you wanted to consider it that way. Now, it hasn't always done this, but what you'll notice is that when this index goes on big runs, it does very well. I'm not saying it's going on a big run, but when you're looking to spot something, why not bring this into your analysis? It's something I do in the mentoring. And if you're interested in the private group mentoring, we've got like 1 or 2 spots left. There's a sale down below. I'd highly suggest it. I think it really brings a lot of high-level thinking to the markets. And this is another one that's really big here. This is JETS versus the volume-weighted average of the S&P 500. So basically, we've got here really a recovery play concept. And you'll notice that it's been pointing towards nothing that great for the American market in terms of tourism and tourism stocks for quite some time. But if it had breached through this trend line, that was really the final piece in the puzzle towards tourism and everything like that. Now, of course, what does the invasion do? It ruins that concept, and that's why it's sold off since that point. But look at this chart. You've got a basing, you've got a double bottom, you've obviously got a bit of a flag here, and then, of course, you've got strength into that trend line. So when you add technical analysis along with this concept, you're probably starting to see there's a totally different way of looking at markets that many people don't do. Some of you probably do it. If you do it, let me know in the comments down below. But that's one of the things that you should be looking at. Think of markets against other markets. It's a very important concept. And we've detailed that on gold, where you could have traded gold versus the US, or you could have traded gold versus other currencies and done a lot better. Remember, that's also a big concept here. So here's the DAX. The DAX is showing weakness, and this is where we get divergence between markets. This is the German market. Basically, it's back to the 2020 highs. It doesn't look good, all right? There's no way of really looking at this market and saying, oh, that looks fantastic. It just doesn't at this stage. There's so much weirdness going on here. We've got the German market doing really poorly. We have the Dow here showing Wyckoff still. Remember, this is some false breaks to the upside, and we've got that huge support that we're currently waiting to breach. And I think on the weekly, we're going to get a big idea whether this market wants to go short or long, because we haven't quite currently breached under this zone here. We've gotten underneath it, but we haven't closed underneath it. Imagine if the Dow puts in a red week this week. It's not a good signal, everyone. It's one of those things that you've got to pay attention to. Look, we thought maybe if there was follow through after this huge bullish hammer, the Thor hammer, if there was follow through on that trade, I think you got to go long. You got to know when to hold them and when to move. But at this stage, we're stuck in the middle of nowhere land. And that makes it kind of tough, because you know that the Fed's coming out. We just don't know exactly on the directions. Why we say when the VIX is above 20, you've got to be nimble, you've got to be fast, and you've got to kind of just make quick decisions. So here's the US 100, the NASDAQ from the previous session. We talked about this zone. We obviously talked about the inverse head and shoulders that we're showing. And we discussed how if it got through here, again, you might have wanted to be bullish on the session, possibly even bullish for a few sessions to go and test these levels up here. It's not what it did. It didn't break through. And there was a big fight between the bulls and the bears for a lot of the day. If you think about it, this was the war zone. This effectively was an area where the market was like, yeah, we're going long. Oh, no, we're not. Yeah, we're going long. Oh, we're not. And probably a lot of people got chopped up in that. And a lot of scalpers would have got hit on their little stop losses. And then it ended up shorting through. It's not currently a positive looking market. If you think about it from the 2-hour perspective, at least currently, if it breaches through here, totally different game. That's where the bulls come back in. Okay, cool. Bulls are back in. The bears kind of, you could see them pushing this down to 13,700, and they're really waiting on the Fed and Jerome to see what they're going to do next. I think that's a big thing here. The S&P 500 is similar. It's shown weakness here. We've obviously got our major trend lines on both cases. We've hit that main one. We're shown weakness. On the 15-minute again, it did the same thing, except the S&P 500 gave you a little bit better signal because, of course, it showed that it wanted to kind of go down here through the session. And if it breaches underneath this zone, the next stop is going to be around that 42.64. And if it gets underneath there, similar to the NAS, it could be going all the way back down to test the lows. So there's a lot of stuff going on here. It's case by case. Be reactive to the market. Don't necessarily be predictive right now. I think that's probably one of the big things I'm trying to do. Now, Bitcoin is a totally, you would say, oh, it's decoupled itself. And it has, because, of course, what we've seen going on with the money in Russia, it's bad. I mean, the ruble or whatever is fallen like, 20 or 30%. It's a complete catastrophe. And what people have been doing in the crypto community is they kind of predicted, and rightfully so, at least initially, that people in Russia would quickly get into Bitcoin. And we saw massive inflows into the crypto markets. And that's created, of course, this story, which makes some logical sense. The problem is now you're at the resistance. So if the market falls off, it's still a risky asset. We know that it does tend to fall with the NAS if that's what's happening. The NASDAQ falls off. Often they are coupled together. So watch it here, because 44,000, you see the closures. It's a key zone. If it breaches through here, it's going to struggle around 46. This area here is like literally the fight between the bulls and the bears. And if you get past there, you've put in a massive double bottom, and you've got to think crypto is going to go different to the rest of the market. But at this stage, right at the resistance, something to be watching. In terms of big news, we've got Fed Chair Powell testifying 10 a.m. That's going to be a big one. We've got ISM Services PMI as well coming out on the Thursday session. That's going to be a big bit of information. And really, we've also got before that, we've got the ADP first print, and we also have the OPEC meetings. I mean, this is all bad, and we've got Fed Chair Powell testifying. So Wednesday, we've got all this stuff, 10 a.m. and OPEC all day and all that type of stuff. On Thursday, we have even more. And then on Friday, we have the big number, which is, of course, the unemployment rate and the non-farm employment change. So all of that's going to be big. If you enjoyed today's video, please remember to, of course, subscribe and smash that like button. If you haven't already, follow us over on Twitter, and of course, join our public Discord or private Discord if you're interested. And if you are interested as well, we have a sale on some of our courses to teach you more about technical analysis and the markets at large. So join us over on the links down below or whatever else you'd like to be doing. Thanks so much, and we'll see you in the next video. Bye for now.